One of the most curious and persistent illusions that besets the human mind in regard to the ownership of common stocks is the belief that speed in acquiring wealth is synonymous with soundness. It may be stated bluntly, the desire to get rich quickly is apt to be the slowest and most certain way to become rich slowly, if one becomes rich at all. The paradox is simple, and yet it remains widely misunderstood. Haste, performed under the banner of cleverness, ordinarily destroys what patience might have preserved. Speculation, masquerading as investment, more often than not converts capital into an experiment. Now let us observe the matter in an analytical light. The essential difference between investment and speculation is not a question of instrument or of market. It is a question of method and of purpose. An investment operation, properly so called, is one which, upon thorough analysis, promises safety of principle and an adequate return. Anything that fails to meet these requirements is speculative. This distinction is not a quaint quibble, it is the bedrock of rational financial behavior, yet the halls and parlors of finance are continually occupied by men and women who confuse activity with productivity. They trade because they feel busy. They buy because the ticker has been kind to their neighbor. In such an atmosphere, speed becomes a virtue only insofar as it produces a margin of safety, and speed rarely produces that. Consider what is meant by getting rich quickly. It usually implies purchasing with the expectation of rapid appreciation in price, often predicated upon a forecast of future events, of broader favorable sentiment, or upon other people's willingness to pay still more. That is, it is betting on the market rather than on the intrinsic strength of a business. The market, in the short run, behaves like a voting machine. Over the long run, it will tend toward weighing the underlying realities. But for the votary of quick riches, the short run is everything. He seeks to ride the wave of popular opinion and to dismount before the wave breaks. The trouble is that the timing of the breaking is uncertain, the amplitude of the wave often greater than expected, and the margin of error in any forecast is, in practice, larger than the expectant investor allows. It follows, then, that the one basic protection for the ordinary investor is not foresight, but restraint. There is no merit in a theory which tells the investor he can safely pay any price today because tomorrow he expects the price to be higher. To pay without margin is to invite loss. The central concept to which all simpler rules reduce is the margin of safety. Buy at a price sufficiently below what reasoned analysis indicates to be intrinsic value so that in the event of an error in judgment, unforeseen misfortune, or a change in tastes or technology, the principle is still preserved. Pace of accumulation is then a secondary matter. First, preserve the stake. Let us make this concrete. Suppose a purchaser expects a special event, the liberation of an occupied market, the announcement of a new product, a sudden change in management that will cause earnings to explode and therefore the stock price to soar. He will pay up for the chance. If the event occurs and the price rises, he is right in outcome, but not necessarily in method. He simply benefited from good luck. If the event fails to materialize, or if competitors erode the anticipated advantage, he suffers loss. Even when the event materializes, the marketplace is not perfectly efficient in timing it. The price may have already anticipated the event. Thus, speed in reacting to rumor or expectation is seldom accompanied by a commensurate increase in objective probability of success. Now let us examine the mechanics of speculation as a mode of behavior. Speculation may take many forms: the purchase of a stock in the hope of a takeover bid, the buying of options or securities with an asymmetric risk profile, the acquisition of a high-price growth issue based on projected earnings 5 years hence, or the leveraging of positions through borrowed money. Each of these activities increases the velocity of potential gain, but also accelerates the velocity of potential loss. Borrowed money, above all, is the entrepreneur's tool, not the investor's friend. Leverage magnifies errors, and when arising from a speculative motive, it usually converts temporary price volatility into permanent loss. The average investor is especially vulnerable because his resources are limited, his knowledge fragmentary, and his psychology malleable. He observes those who have gained wealth rapidly and attributes their success to skill rather than to a mixture of skill, luck, and the compounding of fortunate events. The mass media and popular journals glorify the exceptional case and thus impart a false image of the general probabilities. The result is an irresistible temptation to imitate the apparent winners. But true investing requires a temperament which is neither sanguine in boom nor depressive in bust. It requires, above all, an admission of one's own limitations and a willingness to accept ordinary returns in exchange for reasonable safety. Permit me, then, to set out a series of propositions which, if followed, will make the path toward reasonable wealth steady, slow, and, above all, consistent. First proposition: place primary emphasis upon the value of capital rather than upon the anticipation of capital gains. The purpose of holding securities is to own a share of a business. When one buys with the expectation that the price of a ticket will change, one is not buying an interest in enterprise, but in opinion. Buy the enterprise, do not buy the opinion. This distinction directs attention away from the ticker and toward the annual reports and balance sheets. Price is a fact on the tape. Value is a reasoned conclusion drawn from facts about assets, earnings, dividends, and prospects. Second proposition: insist upon a margin of safety. It is a practical and not a rhetorical rule. Its quantitative manifestation varies with the circumstances. For a bond and a conservative industrial, the margin must be ample. For a speculative venture, it is non-existent. The margin of safety is not a formula to be applied without judgment. It is a discipline of the mind that keeps one from paying full freight when uncertainties remain. Third proposition: diversify sensibly. Diversification is insurance against the unknown. To own all or most of one's wealth in a single issue is the act of a gambler who confuses confidence with omniscience. But over-diversification, in which one holds innumerable issues without the ability to study them, undoes the benefits of selection. The prudent course lies between error from concentration and error from neglect, sufficient variety to prevent a single catastrophe from ruining one's capital, yet sufficient attention to the issues selected to justify ownership. Fourth proposition: avoid the temptations of timing. The attempt to buy at the absolute bottom and to sell at the absolute top is a form of picturesque insanity. The market's moods are volatile. They are sometimes sensible and often not. The investor's task is to buy cheaply when prices are low relative to value and to sell when prices exceed reasoned estimates of worth, but to resist the illusion that one can time the market by moods alone. Fifth proposition: keep a disciplined separation between investment and speculation. If one chooses to speculate, do so knowingly and with a small portion of the capital. Never mingle speculative and investment operations in the same account. This protects the investor not only financially but psychologically. It prevents the fever of speculation from infecting what ought to be a sedate pursuit. The foregoing propositions are well-worn counsel, and yet their practice is uncommon. Let us now analyze why that is so, returning to the question of speed. Rapid accumulation of wealth calls for high rates of return. High rates of return, if they are to be realized over short intervals, require high risk, because in finance, rate is the prize for bearing uncertainty. The difference between ordinary and extraordinary return is rarely one of additional skill alone. It is frequently an acceptance of additional peril. When an investor desires a large return over a short time, he must either accept a high probability of loss or act upon an expectation that others will accept lower returns later. The latter is a crowd game, and, as any student of history will observe, the crowd is fickle. There is, moreover, an arithmetic argument against the obsession with speed. Consider two hypothetical investors, one who obtains a modest but consistent return compounded over several decades, the other who occasionally hits upon spectacular gains, but in between endures sizable drawdowns. Compounding favors the steady hand. A ruinous loss, such as a halving of capital, requires a 100% gain merely to restore the original stake. The faster one seeks to amass fortune by the sword, the greater the chance that a single stroke will sever the source of future compound growth. Now I should emphasize an important, often overlooked point. Opportunity cost is real. In the mania for speed, investors overlook the fact that money lost may deprive them of better opportunities in the future. Prudence creates optionality. A small but intact stake allows one to take advantage of true bargains when they appear. A large but impaired stake rarely grants that freedom. Thus, speed pursued at the cost of safety reduces, not augments, the capacity to profit subsequently. Let us take a moment to inspect the psychology which propels the urge for quick enrichment. There are two principal motives at work: greed and imitation. Greed, in the sense of a desire for uncommonly large gain in short order, is an old and simple animal instinct. Imitation, the social lust for consensus, operates by the more subtle means of legitimacy. When many people are buying, the buying appears justified. The two combine in a powerful force. The crowd bids prices upward. The would-be quick rich observes and enlists, and so the cycle builds upon itself. It is true that occasionally an early participant reaps a fortune. Such occasions are lamentably easy to see in retrospect and dangerously hard to predict prospectively. The market's episodic exuberances are, in part, manifestations of what I've elsewhere described as the voting machine. In the throes of optimism, numbers of people vote in favor of a particular investment, driving prices up. In the depths of pessimism, they vote the other way, lowering prices below reasonable expectations. The investor who seeks speed tends to ride this tide, betting that his moment of entry will precede greater enthusiasm. He confuses the apparition of price with the substance of value. Here I must offer a gentle but firm reminder. There is no moral virtue in being active for activity's sake. Speed that is methodical and disciplined can be a virtue in a business operation, but speed that is the offspring of impatience is, in investment, a vice. The difference is that one operates with an analysis and a margin. The other operates on hope and momentum. Now let us explore how these principles apply to different types of investors. I have habitually divided investors into two broad categories: the defensive and the enterprising. Each has a right to exist in a different prescription. The defensive investor is the individual who wishes to secure his capital, achieve a reasonable return, and avoid substantial effort and mental anguish. For him, speed is antithetical to prudence. He should maintain a deliberately diversified portfolio of high-grade bonds and leading common stocks, adjusted periodically but not frequently. He should insist on conservative allocations. For example, a balanced split between equities and fixed income, varying within bounds but never yielding to the charm of extremes. He should prefer stocks with demonstrated earnings, conservative financing, and dividends, and he should refrain from attempting to catch the ephemeral fireworks that brighten the nightly financial page. The defensive investor who seeks rapid gains is attempting to be something other than what his temperament and aims dictate, and the result will often be disappointment. The enterprising investor, by contrast, is prepared to spend time and intellect in search of opportunity. He may pursue undervalued issues, exploit mispricings, and farm for special situations such as liquidations, reorganizations, or understudies of balance sheet anomalies. Yet even here, the prerequisite of success is not haste, but careful study. The enterprising man who attempts to be rapid, who chases every fleeting opportunity without thorough examination, merely amplifies the risks he purports to control. To be enterprising is to be industrious, not to be hasty. It will be profitable at this juncture to remind ourselves of the role of dividends and earnings as stabilizers of value. A stock that pays a consistent dividend embodies a claim upon a portion of a firm's earnings, and so long as that claim is secure, offers a floor to its valuation. Rapid price escalation, divorced from earnings and dividends, is a signal that buyers are speculating upon future changes, and the reliability of those changes is often overestimated. Hence, the prudent investor does well to favor income and visible earnings power. Speedsters prize projected earnings. The prudent favor realized earnings and dividends. The psychological cost of speculating is sometimes higher than the monetary cost. A man who loses half his capital through rashness often carries the mark of that loss for years, not only in analysis, but in the contraction of willingness to seize rational opportunities. Loss teaches, but losses that arise from folly breed not wisdom, but bitterness. A cautious investor who preserves his capital can observe and participate in market opportunities free of the corrosive emotion of regret. That state of mind is more valuable than any fleeting increment of gain. Let us now consider what, in practical terms, an investor should avoid if he wishes to resist the lure of rapid riches. Avoid leverage. Borrowing to finance speculative purchases is an invitation to ruin. Margin calls introduced by brokers in panics can force liquidation at the very moment the speculative thesis collapses. Leverage converts a reversible diminution of fortune into an irreversible loss. The prudent investor views debt as a business tool appropriate for enterprises with predictable cash flows. He does not use borrowed money as a wager on the market's vanity. Avoid the latest fad. Whatever is newest in the financial world usually means that many people have not yet acquired a full and skeptical understanding of it. Novel instruments or hot sectors attract capital before the underlying economics are settled. There is nothing immoral in the new, but the prudent approach is to demand evidence and to wait for demonstrable results rather than to anticipate them. Avoid excessive concentration. To stake one's future upon the correctness of a single judgment about a company or an industry is to overestimate the precision of one's knowledge. Correct positions taken in isolation may prove disastrous if the unexpected occurs. Diversify as a hedge against human fallibility. Avoid the lure of insider advantage. Much of the quick-rich mythology rests on the supposed possession of secret knowledge or privileged contacts. For the average individual, such amenities are rare and unreliable. The investor who depends upon them is practicing a form of unfairness, for it implies reliance upon a skill set that is not generally available or reproducible. Moreover, the legal and moral hazards often outweigh any potential benefit, and these are prohibitions. Now, permit me to suggest affirmative practices. Scrutinize balance sheets. Favor issues whose assets are conservatively stated and whose liabilities are not excessive. Pay particular attention to current assets and current liabilities. Firms with strong net working capital are better positioned to weather cyclical storms. Earnings are important, but earnings alone can be ephemeral. Assets and the capacity to generate cash over time are the foundation. Prefer a margin when buying growth. If one purchases a company with prospects of rapid expansion, insist upon a price that reflects a margin against the risks inherent in growth. High expected growth can be realized, but more commonly it is delayed or disappointed. The prudent course is to buy growth not at any price, but at a price that leaves room for error. Study management, but do not worship it. Competent management is valuable. Deceitful or incompetent management is destructive. Yet management is human and fallible. Do not buy solely because a leader is charismatic. Buy because the financials demonstrate competence and the balance sheet shows prudence. Set rules and follow them. The impartial investor devises policies for allocation and rebalancing and then follows them. He recognizes that discipline beats the sparkle of a new idea more often than not. Rules are not dogmas. They serve to limit the intrusion of emotion and to preserve the hard-won advantage of reason. Now, turning to the public policy implications, a matter on which I have sometimes spoken with restraint and which deserves calm consideration, there are measures authorities might take that would reduce the systemic encouragement of speculative fever without unduly restricting commerce. It would seem reasonable that margin requirements should be set in a manner consistent with the aim of preventing excessive leverage. Margin, by permitting purchases to be financed out of character with the purchaser's actual capital, amplifies market cycles. An increase in margin requirements in a period of frenzied expansion will not eliminate speculation, but it will dampen the velocity of its harmful effects. This is not a matter of moralizing about speculation. It is a matter of prudential moderation. The Federal Reserve, as guardian of credit conditions, should be mindful of margin's role in propagating cycles. Secondly, the tax code influences behavior. Capital gains treatment that encourages the locking in of gains or penalizes rational reallocation can distort investor incentives. Policymakers should attend to incentives that unwittingly promote excessive turnover or discourage the retention of well-valued assets. The aim should be to align taxation with the preservation of capital and the efficient use of resources rather than to create rewards for ephemeral trading. Thirdly, transparency and disclosure remain underappreciated public goods. Investors cannot act prudently without adequate information. Regulations that enhance the clarity and timeliness of corporate disclosures do not foreclose speculation. They instead raise the standard of analysis that speculative bids must meet. When analysis is improved, the market becomes less a casino of rumor and more a forum for reasoned judgment. Fourthly, educational initiatives to promote financial literacy would serve the public interest. Many errors of speculation arise from ignorance rather than malice. Simple programs directed at the average investor that explain the difference between investment and speculation, the meaning of intrinsic value, and the hazards of leverage would help to inoculate the public against the periodic waves of mania that send so many to ruin. Finally, there is a role for the press and popular commentators. They perform a valuable social function in conveying news and analysis, but they should not masquerade as prophets. The responsibility of those who speak to the public is to temper the rhetorical appeal to greed with sober instruction about long-term consequences. One may argue, and with some justice, that the market must be free to allow experimentation and risk-taking. My contention is not for the suppression of risk. It is for the removal of institutional incentives which make risk-taking reckless rather than informed. The proper role of regulation is to ensure that the risks undertaken in speculative ventures are borne knowingly and without the parasitic reliance upon borrowed money or governmental backstops that encourage moral hazard. We arrive then at the closing argument. The investor who seeks to grow his capital sensibly must accept that speed is often the enemy of durability. The paths to wealth that promise rapid ascent are strewn with the detritus of ruined fortunes. The prudent course is one of slow accretion, a steady, disciplined application of reason, of adequate margins, of diversification, and of emotional self-command. The market will never be a machine that pays for impatience. It is a mechanism that rewards understanding and penalizes hubris. Let me not be misunderstood. There is nothing intellectually small about seeking a fair return in an imperfect world. It is, in fact, the highest form of enterprise to try to convert knowledge into durable capital. The man who studies the statements and the facts, who applies a margin of safety and who refuses to be driven by rumor or sudden enthusiasm, is not merely a dour accumulator. He is a builder of a financial legacy that will serve himself, his dependents, and the larger social fabric. Time and experience have taught a final and perhaps the most useful lesson. The market's verdict is not always immediate, but it is eventually honest. Prices may wander. Indeed, they often wander far from reason, but over time, the weighing machine tends to register the true character of the enterprises underlying the securities. One may not hasten this process by cleverness. One may only position oneself so that when the weighing occurs, one is not crushed by error. Therefore, to those who would be rich quickly, I would say, revise your timetable. Amend your ambitions to fit the true nature of the market. Seek reasonable results with methods that protect you from the vicissitudes of fate. Cultivate patience and modesty. Reduce leverage. Demand a margin of safety. And measure the claims you purchase against the cold arithmetic of assets and earnings rather than the warm rhetoric of hope. And to those tempted to glory in the rare case of meteoric gain, remember that luck is not a strategy. If your success depends upon events that cannot be solidly reasoned, treat it as a windfall, not as an achievement to be emulated by hypothesis. Build upon it conservatively. Do not let it seduce you into assuming you have more than you possess. In closing, and I say this without flourish but with insistence, markets, like men, are prone to overstatement. They are eloquent whether they are right or wrong. They can persuade a crowd of its wisdom and then abandon it without apology. The investor's first protection is restraint. His second is the margin of safety. His third is a temperament that is calm in the storm and sober in prosperity. These qualities are the true engines of compound growth. They do not promise the instant gratification of sudden wealth, but they do promise the far greater reward of security through time. We are not, as a people, condemned to repeat the follies of the past. We may, by deliberate education and prudent policy, reduce their frequency and their harm. Individual investors, in particular, need only to practice a small measure of common sense, which is, after all, anything but common. The slow and steady ascent to wealth is not a story to excite the headlines, but it is the one most likely to stand when the headlines have faded.